As we discuss all this, demand for oil is still increasing. So here's the question. Will the push for green energy, will all of this investment into this next wave of stocks create a shortage of the oil we're using today? My next guest says we need both traditional and clean energy, and he's not concerned about an oil supply squeeze. Let's bring in Rob Thummel. He's a portfolio manager and managing director at Tortoise. Rob, so the Journal has a great sort of takeaway on this where they explain the reason why a lot of people think oil could be headed 70, 80, even $100 a barrel is because look at what's happened at Exxon. Look at what's happened in Shell. Oil companies are basically being pressured by their investors not to pump more oil.
Yeah, Kelly, you're exactly right. So if you look over the last, 2010 to 2019, hundreds of billions of dollars were put into the oil and gas sector, and the returns were negative. So as we moved into 2020 and beyond, we've got a new set of management, new set of investors, and here's what they're clearly saying. They're saying to all of these oil companies and these natural gas companies, return cash to us. Show us that you're a good business. And the energy companies and managements have responded, and their stock prices have responded. So the sector in general has gone from the worst performing sector from 2010 to 2019 to this year being one of the best performing sectors in the S&P 500.
Yes.
And we think that this trend will just continue.
So it turns out that oil investors should have been pounding the table for ESG all along. The one thing oil investors should be campaigning for is for ESG investors and funds and what have you to make them divest out of oil because it's incredibly bullish for the energy price. My point is there's no way this can be sustainable. You can't tell me that energy stocks can continue to perform well simply on this idea that the price per barrel is going up, but there's going to be less and less of it pumped and used over time. Or can they?
Well, a couple things, though. So obviously commodity prices have an impact on certain energy stocks, especially the oil and gas producers. And so with the expectation of less capital, the expectation is we'll continue to have lower supply, but demand continues to stay the same. So as a result, the commodity prices have just risen accordingly. However, here's the other important point and why energy stocks could potentially continue to outperform, even in an environment where this decarbonization mega trend really just continues for decades going forward. Because some of the energy companies have gone from resisting this decarbonization trend to embracing and now participating in decarbonization. And that's really important because a lot of energy companies will be part of this energy transition and they'll be winners as a result of that.
But are you really telling me that the likes of the oil majors are performing well this year because they're transitioning their businesses? I mean, are the economics of these new businesses better than the economics of the old one, which is now becoming more attractive as oil prices rise?
Well, I think the bottom line is the cash flows of the underlying companies have improved. And we all know that the cash flows will drive stock prices higher. Obviously, higher commodity prices have helped, especially the majors and other companies as well. But it is the fact that these oil CEOs and Exxon and Chevron in particular are embracing, looking for opportunities to participate in new technologies that could really accelerate the pace of decarbonization. And so what are some of those? Well, carbon capture is a big opportunity. Hydrogen's a big opportunity. Renewable natural gas is a big opportunity. Who can actually pull that off? A lot of people think that potentially that could be some of the big majors. And if they do, that will accelerate their growth profile as well.
Final quick question, Rob. So again, to kind of illustrate what seems like a strange paradigm for these stocks, you have major divestment pushing up oil prices for a key sort of input to the business cycle and something that consumers pay a lot for every day. That's got to lead to demand destruction at some point or no? I mean, are consumers or businesses or others who use oil and oil byproducts going to push back on these higher prices and create demand destruction, or are they going to be able to take it?
Well, we've never come out of a pandemic before to see what the impact on demand is going to be. But so far, what we've seen is there's been tremendous demand for oil-related products and gasoline, and we're probably just getting started, right? It's going to be a summer full of everybody wanting to escape and experience what they weren't able to experience last year. And so demand really seems to be rising no matter what the price is for gasoline. But longer term, gasoline prices probably come back down and oil prices stabilize in the $60 to $70 range. And then we'll see much longer term. What you're talking about is where will demand for oil and gasoline and oil related products be as this energy transition really accelerates. And we look at that every single day. If you think about it, there's a lot of oil related products that are necessary for the clean energy transition for wind turbines and things along those lines as well. So Big picture, we just see that there's a huge opportunity in energy infrastructure in particular, and there's a lot of cash, a lot of dividend yields that'll be coming out of the energy sector. And investors, we think, want dividends, especially in an environment where we've got a 10-year that's so low.
Shepard Smith here. Thanks for watching CNBC on YouTube.